Hello and welcome once again to the Smart Money, Dumb Money Show, and I am your host as usual, Keith Richards. I am President and Chief Portfolio Manager at Value Trend Wealth Management, and I'm a technical analyst, but today we're not going to be talking technicals. Say it ain't so. We're going to use the F word, and the F word is fundamentals, and I have a wonderful guest with me. In fact, some of you might be familiar with him. His name is Peter Hodson, and Peter's been in the business since forever. And I'll do a quick intro on Peter, but one of the cool things that Peter does, and one of the main reasons I wanted him to be on the show, is because Peter runs a retail investor, and that's you guys mostly who are watching this right now. He runs a research program that is accessible to ordinary individual retail investors, just like you guys. And so I think what he's going to have to say, first of all, is going to be quite insightful in today's markets, but also I think, it's going to be fun to talk about what Peter does and how he got involved with forming a research firm that is normally geared towards guys like me in the institutional side. So I think this is going to be a great interview. Before I bring Peter on, I want to just do a quick intro, just so you know who he is, and pardon me for looking down. But Peter's founder and head of research at 5i. I know Peter a bit through the Money Saver. You guys know that I've been writing for the Money Saver for probably 25 years. Originally, the magazine was owned by a guy named Dale and Betty Ennis. And they passed the baton, and Peter, as one of his business ventures, took the magazine over, and I've continued writing for Money Saver and kept in touch with Peter in that way. So Peter's involved with that, but his main business is 5i Research. Now his background, very, very interesting. You guys will be familiar with some of these names. Peter was a lead portfolio manager and a director with Sprott, and he was running the growth, their very well-known, well-regarded Sprott Growth Fund. He was managing director with Dominion Bond Rating Service, so he was involved with the credit rating agency, one of the big ones in Canada, and he's managed $1 billion at Mutual Asset in the small cap area. So we're going to talk a little bit about small caps today. It's one of the things that we want to address because it's something I don't talk a lot about. And finally, he got involved with a company called Synergy Mutual Funds, which later was acquired by CI. And I'm sure a lot of you guys are very familiar with CI. So I want to just welcome Peter to the show and just say, Peter, I'm so thrilled and very happy that you showed up today. Welcome to Value Trend and welcome to the Smart Money, Dumb Money Show.
Thank you very much. As long as I'm not the dumb money side.
Well, let's find out who's the dumbest between the two of us. And as I said, I'm Peter. What's great about having you on is you're a deep fundamental analyst, a value guy, and it's so different than what my audience normally hears from me, which is all these squiggly lines and charts. So I want to start off, and Peter sent me, I asked all my guests, you guys have seen probably 20 of the interviews I've done over the years, and I always ask my guests to give me some ideas on what they think is important to talk about. And one of the things I chose amongst Peter's comments were that, the way the market acts after peak rates are hit. So Peter, could you guide us through sort of where we are in the cycle and what you sort of see happening next?
Sure. So we've gone through about 18 to 20 months of pain as the Federal Reserve put in place the sharpest increase rate in interest rates ever established. So both the Fed and the Bank of Canada were extremely worried about inflation. Inflation peaked at about 9%. And it really scared the policymakers because they were looking at what happened in the 70s, where inflation just pretty much destroyed the world economy, and OPEC, there was an oil crisis and inflation, and there was stagflation. So there was high prices, but no growth. And the Fed really needed to change that. So they hiked rates very, very aggressively and very, very fast. And it was the fastest rate hike ever. So what that did, it basically calmed things down a bit. And what I like to use is the analogy of you're going down a hill. So the economy is, you're in a car and you go down this hill, and the economic car except there's a giant curve at the bottom of the hill. And then, at that curve, there's a giant cliff that plunges into the rocks below. And the Fed is the driver of that car. And what they have to do is they have to make that turn. They have to slow things down so the economy can make that turn and not plunge into an economic recession that's led by inflation. And so they pump the brakes, they pump the brakes, they pump the brakes. And this week, basically yesterday, in fact, the Fed basically said they've successfully made that turn. And they've promised 3 interest rate cuts next year. And so we've had multiple of cut or increases. And frankly, I can't even tell you how many. It was just basically every meeting, they just raised it. And now they've promised us 3 next year. So I don't know if that's going to come to fruition, but basically the Fed is giving you the all clear. It's like, okay, things are slow. They've slowed down enough. We're not going to go over the cliff. And now let's see what's on the road ahead. They still have to watch for signs and watch what's going to happen in the economy. But it looks like the giant problem of runaway inflation and Venezuela, Zimbabwe type of inflation, it looks like they've solved that problem, and now we can get back to business. And then as a fundamental analysis person who likes to focus on companies, this is just this is music to my ears, because the past 2 years, nobody cared how your company was doing. If you had a great company that was growing and doing extremely well and generating cash, no one really cared that much, because it was all about when are these interest rate hikes going to stop and when is inflation going to stop. And so you would have these stocks that go down even though they report great results. And it's just, you pull your hair out and you say, this is ridiculous. And now I think we can get back to more of a fundamental situation where it's like, if your company does well, then somebody's going to buy your stock because it's doing well, because they're not going to be as worried about the macro factors that's been kind of overwhelming over the past couple of years. So if we look at past rate hike cycles, the average return after the last hike, that last interest rate hike, is about 15.5% over a 12 to 16 month period. So that's, after this year, some people have made lots of money. That may not sound so exciting, but after the past 3 years in some sectors of the market, 15.5% just looks fantastic. And investors who lost money last year, lost 20% or 15%, suddenly that looks pretty good again. And so it's important to note that that's the average. So the one thing that kind of can throw things off a little bit is, will there be a recession? And the situation in Canada is a little bit more dire than the US. The US right now is running close to 5% GDP growth, and Canada is basically at 0. And so the Canadian market may be a little bit more muted than the US until they can sort of pick up that economic growth scenario and companies can grow again and people aren't worried about a recession. So you have to have that sort of sentiment shift. And while the Fed has said everything's okay, the consumer has to respond, and investors have to respond, and corporations have to respond, and they can't be scared to invest money again. And so sometimes the market will go down when there's a recession. But this time around, I think we're okay, because people have been talking about a recession for 2 years. Companies have adapted to that worry. They've cut costs. When inflation was high, they really had to hunker down and cut costs. And now we're kind of back to normal. And I think some companies will be willing to spend money and grow again. The other thing that makes things interesting this time around is, even with an economic slowdown that's already been executed in Canada, the employment situation is still very, very strong. Basically, if you want a job, you can get a job. You could probably get 2 jobs right now, the way the economic situation is going. And so I don't think we're going to get into a situation where there's a housing crisis, because people will keep paying their mortgages if they have a job. The financial situation is much better than other cycles because the rules were changed after the financial crisis. Corporate earnings are actually growing again. The third quarter showed the first growth in 3 years. So the corporate earnings recession seems over. And now it's just a question of, okay, what happens next? But I think the big giant fear has gone. And, if you want to say, okay, well, if the big fear is gone, then now let's look at the good side. Let's put on our rose-colored glasses and see how things go. So generally, it's pretty good after the rates stop going up. But as you very well know, markets have a way of throwing a curveball at you. So maybe something else happens to worry people. But right now, we're looking okay.
Well, yeah, that's good to hear. I mean, nothing moves in a straight line either, right? So there's going to be ebbs and flows. I wanted to ask you, you just kind of alluded that many of the companies that, are on the exchanges are in a better financial position than they were, just because of these cutbacks and whatnot they've done. A lot of fat was cut, as you've noted. And in your notes, and I'm going to pin you on this because I'm personally, we're just starting at Value Trend to buy into this sector, so I really dying to hear your take on it. But you know that there's some real cost controls, particularly in the energy sector. So what's your take on that sector? We just started buying in at Value Trend, so I have a vested interest in your answer here.
Okay, well, let's put on our hats. Let's just pretend that you and I are running an energy company. And let's go back 3.5 years, and the price of oil for a day or so was negative $37.
Yeah.
So you and I, as the managers of this oil company, we're basically we're going to go bankrupt at negative $37 prices because it costs us $30 to bring this stuff out of the ground. We're going to lose $67 a barrel. So when you get into a situation like that, the corporations en masse basically react, and it's like, don't spend money, pay down debt, close any unprofitable operations, fire as many people as we can because we don't know when things are going to get better. And they've done that they did that over the past 1.5 years. And of course, oil didn't stay negative. That was an aberration. But people were very, very concerned about $10 oil in the giant, OPEC recession and COVID recession and everything like that. And so now when oil spikes back up to $96, all the corporations have adjusted their financial situation. They've adjusted their cost programs as well. And lo and behold, we're at a point in the cycle for that sector where, on average, of course, there's always aberrations on each side, but on average, corporations are in exceptional financial shape. They're raising dividends. They have no debt. They're just pouring in the cash now at $75, $80 a barrel. They've bought back a ton of stock because they didn't want to spend money on drilling. They were too worried about that. And the way the market developed was investors were rewarding those companies that were buying back stock and increasing dividends. Yet that sort of underlying cyclical mentality is still there. It's still a cyclical sector. People are worried about China growth. People are worried about OPEC. People are worried about too much US production. And these companies are very, very, very cheap on a fundamental basis. Some of these companies are trading at 3.5, 4 times cash flow. And you think about it, it's like, okay, so you could buy the whole company and then it pays for itself from your cash flow in 3 or 4 years. That's a pretty good private equity type of scenario. So, it's always going to be cyclical. There's nothing we can do about that. And, oil could go to $40 if OPEC starts pumping again. But instead of this time around, you're paying 10 or 11 times earnings and you're buying a company with lots of debt, you're paying 3 or 4 times earnings in a company that's got a lot of cash. So your downside risk, if you're wrong in a cyclical market like this, is probably dramatically lower than it was in other cycles. And there's only 1 or 2 companies out there that are spending money making acquisitions and adding debt. But 90% of the companies, all they've done is pay down debt and pay out dividends. And yet nobody cares about their stock. So it's a pretty interesting situation. So we've been saying to our customers, feel free to buy some of these companies at 3 times earnings and get a 5 or 6% dividend. There will be another upcycle. It might be tomorrow or it might be next year, but you're buying them cheap enough anyway. The one thing we are saying though is the TSX right now is, I think, 18% energy. That's probably too much for the average investor because it is a very cyclical sector. But certainly we would have no trouble with investors at 10% or 12% or 9% energy exposure, just because in terms of valuation, we can't see any other sector that's as cheap as that.
Excellent. Yeah. And I guess by the time people see this interview, Peter, it'll be closer to the end of December. But it's today, we're recording this on the 14th of, is it? Yeah, the 14th of December. And I just finished writing a blog and posting it this morning on the energy sector. I called it Opportunity in Energy. And what I noted is that from a technical perspective, there's pretty strong support on oil at $65 a barrel, like very, very strong technical support. And even in the producers, if we just look at the XEG, the iShares Canadian orientated one, it's the same idea. It's maybe got a little bit more potential downside from a technical perspective, but generally speaking, they're both in this zone where there's very little downside from even from a technical perspective. So here you are saying, look, 3 to 4 times earnings growth, and here I'm saying technical support is within 5% of the current pricing. You really don't have an awful lot of downside versus a little bit of patience can give you a probable upside. So yeah, we're in the same camp here. So I want to I'm gonna our last question is going to be about small caps, but we're not going there yet. Because I have a real interest in that too. But you mentioned that there's about 6 trillion in cash on the sidelines. So, talk about that and talk about where you see that cash might be going.
Sure. So what happened over the past couple of years? Basically every month that interest rates went up, people got worried about a recession. They got worried about the stock market. And they finally started making money if they put money in the bank or they put money in a GIC or a money market. So every month there was kind of a consistent flow of money leaving equities and going into fixed income. So when rates were 3%, people are like, well, that's not that great. But then they go to 3.5%, and suddenly that's pretty good. Then they go to 4, 5, 5.5, and I think they peaked just over 6. So suddenly, again, if we compare 2022, you might have lost 15% in the stock market in 2022, and now someone's offering you a guaranteed 6% GIC. I mean, that's a very easy switch for a scared investor to make when all they read about is high interest rates, high inflation, and a giant recession coming. So they make that switch, and that money just sort of starts piling up on the sidelines. So now it's a question. We've got the reverse. Interest rates have not really come down yet officially, but they've certainly come down in the bond market. And so things are going to tick down, and that 6% GIC is now probably 5.5. Next year, it might be 4.5. And so the whole reason for putting money away is kind of disappearing. Meanwhile, this month or in November alone, you could have made 10% in the stock market. So now 3.5 is not so good, but you can make 10% a month. Now, obviously, that's not going to happen every month. But as the market calms down a little bit, and as we avoid that cliff at the end of the curve, some of that money is going to come back, and it's going to trickle back, and that should support equity valuations and support the stock market. And it won't all come back at once, which is really why we like it more, because what happens is the market calms down, goes up a little bit, and then that money becomes more confident in the move over. So more money will come over because we escaped that giant recession. Let's go back into the market. And that could happen over 3 years, but that might mean 3 years of sort of good returns if that does indeed occur. Again, there'll be something that happens along the way that messes that up. But there's some experts are talking about 3%, 2.5% interest rates 2 years from now. And that, for me as a stock market investor, I would rather lose money in the market than make 2%, because at least I'm going to have more fun on the stock side.
There's an attitude for you.
Yeah, I mean, and if things work out, I'm going to make 20, 25. So that's not a bad. I have fun. I might lose a little bit, but I'm not going to just sit around bored at 2% in the bank.
Exactly. Yeah. I'm a big believer, Peter, in risk reward analysis, and I do it technically, but you can do it fundamentally. It doesn't matter how you look at it. Understanding that there's always risk present, there's always reward potential present. They're both there, and all you can do, because you really don't know what's going to happen, because like you said, the next black swan is tomorrow, and maybe somebody sends a nuke at California or something. Who knows, right? But whatever the only thing you can do is measure these relative trade-offs and then place your bets accordingly. And if it's fairly obvious that there's a better, given that risk and reward are there, a better chance to make some reward versus that potential downside risk, I'll take that bet every time. And that's what I guess what we're in the business of doing, isn't it?
Absolutely.
So I know you mentioned something about profit margins with AI. So, you know, I'm saving that juicy one about the small caps till last, because I know you're an expert in that area, and it's of great interest. So I'm teasing myself by not asking right away. But you mentioned something about AI, and you know, that's been a hot topic early this year. It's really not been a hot topic over the summer. Where do you see that sector going?
Sure. I think it's still going to be a hot topic for a period of time because, frankly, most companies are looking at it and they're worried their competitive position if they don't go down that path. So, you know, there's a lot of money being spent, and I think that'll probably last for, I would say, maybe 2 more years before companies either decide that that money was well spent or thrown away. But if you look at the two of the biggest problems we have in the economy today, at least in North America, it's higher prices and lack of labor. And if you can get technology, not necessarily AI, but any technology has the ability to drive down costs and help alleviate that labor situation, then that's going to be very, very good for profit margins, which is going to be good for corporate profits, and then therefore the stock market. So it's a situation where I think a lot of companies have to spend money just because the cost savings and the productivity improvements are just going to be too great if they don't. Now, some are going to fail and some are going to go down the wrong path. And there's going to be a lot of bubbles created because sometimes there'll be a company that, you know, thinks they've solved the problem and they don't really solve the problem. And a lot of people will waste money on that. But absolutely, I think it, you know, in terms of, I don't want to call it a bubble, but in terms of spending patterns, I think that the spending on AI is going to last for longer than what people expect, just because the incremental gains you can get if you do it right they can't be ignored by the corporations. I mean, some corporations might have the ability to drive down costs 25%. And of course, that just goes right straight to the bottom line and probably right into some of the executives' pockets as bonuses as well. So the incentives are just too great. And the money that's being thrown at the sector, you know, I don't want to say an unlimited amount of money is going to solve all the problems, but when Alphabet's spending $40 billion a year on research, they got to come up with something useful with that. I mean, again, some companies will screw up, but when you add up the collective amount of money that's being spent, there's going to be some very, very good initiatives and good cost saving plans that are developed out of all that money. I mean, it's not $1 trillion yet, but it's, you know, hundreds and hundreds of billions of dollars is being spent to improve day-to-day life at companies. And so I don't see how that's a bad thing. I mean, obviously it's a bad thing because you got to spend the money first, but then the rewards from that will be incremental and will last decades. So I think that we're going to be talking about this for quite a long time. In some of our research, you know, we've seen reports basically saying that every company in the world is going to have to spend millions and millions of dollars on AI. And so if you do the math, multiply millions and millions of dollars by every company in the world, you get to be some big numbers. And so I can see the excitement there. And again, but like any sort of trend, you want to stick with quality. And a lot of our customers they're looking for the next greatest little company that's going to be the big AI winner. And unfortunately, we don't have a lot of suggestions for them because the little companies, they can't spend $40 billion a year on research. And therefore, they're more likely to be left behind from the big players that have that ability to spend. So, but the money is going to be spent for sure. And I think investors are going to, I think the next stage, perhaps after a year, is instead of buying the companies that are providing the AI solutions, they're going to be looking for companies that are benefiting from those AI solutions. And I think that might be the 2025 AI focus.
Okay, yeah, that actually reminds me of, you know, we've both been around a few years. And, you know, we both lived through the tech bubble. It was interesting because if you go back to like 98, 99, all that hype with, you know, Global Crossings and Nortel and every other, you know, Juniper networks, like the concept back then was, oh yeah, well, you know, with the expanding need for internet bandwidth and all that, this is the bee's knees, and you got to buy Nortel or whatever. Yeah. And what it ended up being, and this is to your point right now about AI, it ended up being that it really wasn't those guys that made the money. I mean, beyond Nortel cooking the books, but I'm talking about legitimate, companies involved with creating, the switching devices, bandwidth, and all this stuff they were doing. It was the end user. It was like you and I, we could at home for $50 a month or whatever it was, get an internet connection. That's who won.
Absolutely. Yeah, absolutely. And I 100% agree with you, because the rest of it is kind of a commodity. And I think even AI is going to become a commodity, and it'll be those companies like how Amazon figured out online shopping, or how Shopify figured out how to help merchants, compete with Amazon. It's those companies that are able to use the technology to improve their own business. I think that's where the high margins are, because those companies didn't have to spend all that money on the infrastructure. They just get to use the benefits of it.
Yeah. So it's often it's the end user, right? So I will my final question will be the small caps, and I'm going to set it up a little bit, but after we talk about small caps, I would like to talk a little bit about the 5i research and just how it works, and how some of my audience, if they wanted to explore it, can look at it. But let's set it up for the small caps, because I was mentioning to you, I'm a technical guy. I have to look at the charts, and if we look at since the beginning of 2022, and we look at the benchmark, Russell 2000 small cap index, it has been up and down in a very tight, beautiful trading range. Like guys like me, we love this stuff because we go in, we go out, over and over again. But it's really not. I mean, while the S&P and the Dow and heck, even the TSX kind of broke out of at least some sort of a bottom formation, maybe aren't quite at their old highs yet, but they're certainly showing signs of getting there. The Russell 2000 continues. It's at the top of its bandwidth now, at the top of its range, but it's just not breaking out. And so, you note that, well, maybe the small caps are undervalued, and they have been for the better part of 2 years. So what do you think would be I guess you maybe partly answered it, but, what do you think some of the catalysts, and why do you think they might actually find some light in the next?
Sure. So I guess just as background, small caps are typically always more expensive than large caps. And most people have they don't understand that really why that is right away, because there's well, the bigger company is safer. They've got lots of cash, et cetera, et cetera, et cetera. But it's because the small caps, specifically because they're smaller, they have the ability to grow at a faster rate. If you and I have a little oil company and we find oil, then the leverage to that being a small company is much bigger. So they've typically had a much higher valuation than large caps. And historically, they've had the best return of any market capitalization sector. But over the past couple of years, post-COVID, going into high interest rates, going into high inflation, and going into investor concern, the big companies were safer, and that safety gave them a premium over small caps that they hadn't seen in almost ever. And the last time we got that wide in terms of difference in valuations was in the financial crisis of 2008, 2009. And that made much more sense, because the world was kind of ending back then. And if the world's going to end, it'll be the small companies that go under first. They don't have the cash flow, they don't have the resources. And that makes sense. But the past couple of years hasn't made a lot of sense. It's all been about fear. Even though most companies in the small cap land, they don't have debt, because nobody likes a company that's small and has debt. They're very nimble. They're growing fast. For the most part, they didn't suffer an earnings recession like some of the other companies did over the past 3 quarters. They've got the privatization opportunities. There's been a lot of small caps that went public. Their stock got cut in half, and they kind of said, screw this. I don't like being public. We'll just go private again. And there's 8 or 9 examples of that over the past 6 or 7 months in Canada. So I think really what we need the predictions of lower interest rates to come to fruition. That's obviously going to help. And that will help in terms of just overall confidence. So the sector itself does pretty well when there's confidence. When you're confident that the world's not going to end and there's not going to be a recession, you're more willing to take a chance on a smaller company. So we've had a really nice kind of 5 or 6 week rally. Once the Fed kind of said that's the end of interest rates, we might get a big January bounce. Small caps really tend to do well in January because they get sold at year end for tax losses and things like that. And they bounce in January. But I really do think that if investors are looking for growth again, and the Magnificent Seven tech stocks are too expensive, then they should naturally look into small caps and mid caps. They might go to mid caps first, because again, you don't go all in on the risky sector. You kind of take your time and make baby steps. But if it's growth and valuation that you want, investors should start looking at the small caps. And I think, I'll leave you to the technical side, but from a fundamental side, we're starting to see accelerating earnings. We're starting to see valuations shift a little bit. Companies they've done buybacks because no one cared about their stock last year, and so they bought back a bunch of stock. So we're seeing some signs of nice momentum, and we're seeing earnings revisions. We're seeing positive earnings surprises, and we're also seeing broker upgrades. So even the analysts now at the brokerage community are starting to display a little bit more confidence and say, okay, we're going to raise that target from 50 to 80. And you go, well, that's a pretty big target range. And so again, just little signs like that we're seeing. So I think if we meet back in 6 months, I think they will have broken out by then for sure.
Yeah, and that's it. It's we have a CFA on our stuff, Craig O'Coin, and much like yourself, he's a value guy, and we combine it. He's been pointing out some of this stuff like oil. That's how we got started on that. We combine it in that we see the value, and then we're looking for the technical signals that would suggest it's an actual breakout rather than just yet another head fake within a value space. So we're definitely keeping a close eye on that, and that's why I wanted to bring the attention back to that. So let's just finish up. The 5i research service that you offer, I think it's a fabulous service for retail investors. And so I want you to maybe bring us through it. Like, how does it work and what does it cost? And just, some ideas on why some of my viewers, which are largely do-it-yourself investors, might want to take a look at it.
Sure. Appreciate it. Thank you. So 5i, we started in late 2011. So we're 12 or 13 years now. And we really offer a few services for the do-it-yourself investor. And our tagline is do-it-yourself doesn't mean do it alone. So we're trying to help out the do-it-yourself investor. So our services include research reports on Canadian companies. We only follow Canadian companies on a formal basis. We talk a lot about US companies, but in terms of research, it's just Canadian companies. And we look at about 65 companies that typically don't get a lot of attention from Bay Street, companies that we like with strong management and strong fundamentals. And so those reports are available to all our members. We also offer a question and answer service. And this is where people really, really kind of like this service. We've answered almost 180,000 questions since we started up. And it's because we don't trade in Canadian stocks. So we don't have a compliance department to worry about. So if you ask us about XYZ company, we don't have to check with our underwriters, and we don't have to check with compliance to say, are we allowed to say anything about XYZ company, because we don't involve ourselves with Canadian stocks on a trading level. And so we can tell you whatever we want. If it's a crappy company, we'll tell you. If it's a great company, we'll tell you. And the questions range from anything and everything. Like, our customers will ask us anything about taxes, RSPs, the new home savings plan, anything at all. And of course, we don't know all the answers, but we have a pretty good set of resources that we can direct investors to. So, and all those questions, you can ask a private question, but we don't use your full name, so no one cares. So the 180,000 questions are all available in our archives as well. And people like this because we can refer them to an answer we made, 10 years ago. And just as a storyline, there's a I don't know if you want me to talk about individual companies, but Constellation Software is $3,300 right now. And people are saying, oh, I think it's too expensive. And we reference them back to questions we got in 2014 when we would get a question saying, hey, Constellation's $135. Do you think it's too expensive? and that kind of answers their own question for them. It's like, well, everybody thought it was expensive at $135, and now look where it is. So we like that, having as a track record, but also when we make a mistake, we don't eliminate that question from the archives as well. It's there for everybody to see. And then the other service we offer is we offer 3 model portfolios. So people always were asking us, what should I do? And we don't know our clients' personal situations. We don't know their objectives or anything like that. So we can't tell you what to do, but we can tell you what we would do. And so we have a growth model, a balance model, and an income model that people can follow. And some of our customers follow them, just they do whatever we do in the portfolio, they do on their own. But again, that's up to them. It's still do it yourself, and we don't direct them in any way. And then a final, it's an add-on service we have is called Portfolio Analytics. And that's where you put in your portfolio. We ask you a million questions, and then we let you know whether that portfolio is meeting your objectives and perhaps how you could sort of adapt it to better suit your needs. And so those are really the 4 services. And we have a team of 7. I used to be a swimmer. I wake up at 5 o'clock in the morning and answer most of the questions before everyone's awake. It just works out better that way. And we put out blogs and things like that, just like you do, just to talk about interesting things in the market.
And Peter, so a retail investor wants to get involved with your program. How much does it cost, and what do they do?
Well, we just raised the price, so sorry about that. It's $249 a year, and that gets you a login that gets you access to all of our services and gets you access to asking questions as well. And the question side, we can usually answer a question within 24 hours. Some take longer, and some we don't know the answer, but it's a pretty fast turnaround. And what else? And that includes a couple of special reports a year, and access, like when we do a portfolio change, you get an email alert to let you know what's happening. And the other thing that's interesting is you don't have to read all our questions. You can give us a list of 8 stocks that you like, and we will send you a daily email whenever somebody asks a question about those 8 stocks. So,
oh, cool. So it falls outside of even the stuff that you're specifically looking at. You've got
exactly
a chat.
Exactly.
That's fantastic. So, I'll just, to the audience, like, people know I'm a professional portfolio manager. And so we buy research, but the one thing that we do, and this ties into what Peter's offering retail investors, is we only buy independent research. And people that read my blog regularly know that I'm almost evangelistical about the need to stay away from sell side research, and I'll explain what that means. Peter knows what it means, and away from the media, because the media is plugging a message, often delivering a message by the Fed, by the way, but that's another side of it. But sell side research, which is brokers research. Okay, so I don't care. I came from the brokerage world. I worked with Wood Gundy and Merrill Lynch before that, and a few others. And they're all doing the same thing, which is they only have one word: buy. So their word would be sell this and buy that, but they never say, well, let's just outright sell this. You don't get a lot of sells, and there's an absolute bias. They write new issues. They have an investment banking side. There's all these biases that sell side research and then the media itself carries with them. And I've often pointed out on my blog, I'll actually print a story saying, whatever, and then I'll show you what actually happened like 3 months later, and they're always dead wrong. So the beauty of independent research, like what 5i does, and any way you can use your own analytics or whatever, is that you're not being influenced by someone with a hidden agenda. Like Peter's agenda is ultimately to provide good research. He lives and dies by that sort. I do the same thing. I mean, I can be a wonderful talker, but if I don't invest money properly, then people will leave my services and I'll go broke. So it's really, you want to always think in terms of who's got your back. And I really do believe that the only way is independent. And $250 for an independent research firm to be in your, got your back. It's a joke. I'm just telling you, you get one idea a year and you've more than paid for it. Okay, so anyways, I'm not here to sell what Peter, I have no association with Peter beyond I write for the Money Saver. But I just think that, you know, this is the kind of stuff that we all need to look at, which is, you know, making sure any source that we use has got your back.
Right.
So thank you, Peter, for coming on, and I will look forward to maybe talking to you again in another year or so, and we'll catch up on all your ideas. And
All
in the
right.
meantime, you know,
Thank you so much. It's been a pleasure. Appreciate it.
yeah, fantastic. So again, thank you very much.